I hope you feel as lucky as I do to have so many leaders in the industry with us today, giving so much insight, and we're just halfway through. This is a very special moment also to be in this room once again with you this year. And I just want to introduce Adam Emmerich from Wachtell, who will be in conversation today with John Gray of Blackstone. They need no introduction, so I won't give much more than that. I'm super excited for their conversation, and I invite them up to the stage.
Thanks again for all of you for being here. We're lucky to have John Gray with us today. John really is a legend in real estate investing who hardly needs an introduction. I'll give a super brief introduction. John started at Blackstone after college. His first and only job. I think he's made a success of it.
I've certainly tried.
John was, behind legendary deals like the buyout of EOP with Sam Zell on the other side, Hilton Hotels, which was multiple deals within deals. John is today transcended the pure real estate role as president at Blackstone, and we'll kind of use today to talk mostly about real estate and real estate stuff since we're here at the NYU REIT M&A conference. This is a slot, I'll just detour for 1 second, that we've all had the pleasure of sharing with Sam Zell for many years. Sam was a regular, a perennial. He was, a unique character, and John knew him, I think, probably better than I did, and was in the clutches. John, let me just, before we get to talking about all the things in your world and Blackstone, if you have share a thought with us on Sam and your relationship with him.
Well, thank you, Adam. It's great to be here with everybody. I apologize for those in the obstructed views back that way. Sam was a legend. He was larger than life. Ironically, Sam and I grew up in the same small town, Highland Park, Illinois, in suburban Chicago, about 30 years apart. That's probably where the comparison ends in terms of colorfulness sitting here. I'm not going to use the F word at all today, so it's going to be less entertaining than if Sam was sitting here. But the thing about Sam was he was such an iconoclast. He looked at the world in a very unique way. He obviously was brilliant. He would seize on opportunities in a way so many other people wouldn't. And he had a clarity of vision. And if you think about the modern REIT industry today, it would not exist the way it does if Sam hadn't come along with what he did with EQR, with Equity Lifestyle, with Equity Office, the way he brought about sort of modern governance and scale to the REIT industry. And we all owe him a huge debt of gratitude for that. He also was pioneering in terms of geographies. Sam went to Brazil and Mexico and built companies. He met people around the world. He was always trying to learn and do different things. And, what you loved about Sam, most of us are either too cautious or sensitive. We don't say what's on our mind. And Sam told you. So when we were negotiating EOP, if Sam was unhappy, he would let me know. And I had enormous respect for him, and he left a great legacy, and I feel honored to be here today.
Thank you, John. It's really nice to hear those words. Sam was literally here last year. I think he left the conference and went home to his last public engagement. So here we are. Let me zoom out, and we've been talking a lot this morning. All kinds of people involved in different parts of the real estate industry. I think the commonality was WTF, not to use any bad words, but what is going on in the world? What's your take on where we're going with inflation, with interest rates, with stability, with the public equity markets?
Well, I start on some positives because that's my nature. The economy has been remarkably resilient. I think any of us, if we would have sat around a couple years ago and said the Fed's going to raise rates 550 basis points and shrink its balance sheet a bunch, you would say we'd be in the midst of a pretty tough recession, and yet we have unemployment below 4%. And when we look across our portfolio companies, we still see pretty good revenue growth in most of our companies. Defaults in our corporate credit area, we have a couple thousand non-investment grade borrowers. Defaults are still extremely low, less than 0.5%. Those are not signs of an economy in a lot of extrema, and so that's positive. Now, I do believe we're seeing some signs of deceleration, and I do believe as rates are held at high levels for an extended period of time, it will cause further deceleration. But I would say overall, we're on pretty good ground in terms of the economy. As it relates to inflation, I would say the path of deflation remains downward, but the pace of disinflation has slowed. And so I think everybody's looked at a bit of the data now and said, oh my God, is inflation reaccelerating? We've seen some rise in commodity prices, but when you look at our data again, if you look at apartment rents, which many of the people in this room know, in much of the country, they're flat now. If you look at input costs at our companies, again, pretty flat. Hotel room rates in some cases are negative. We're seeing those signs out there. And then when you look at wages in our portfolio, a year ago they were running at 5%, now 4%. So what I'd say stepping back is I think the Fed is ultimately going to be successful driving inflation down. It may take a little longer than the markets had hoped, but that path of travel is in the right direction. And so that should be helpful to this industry, but it's not happening overnight, and you need a little bit of patience. And on the flip side, as investors, if you feel confident about where things are going, but there's a lot of uncertainty, it does create a moment of opportunity.
So you've been active in the multifamily sector this year, Tricon, AAR. What's the thesis there? You're famously a person in an enterprise that thinks about sectors, and you seem all in this year on multifamily.
Well, I would say it's rental housing writ large, because in the case of Air Communities, it's obviously a big multifamily $10 billion company. Tricon, which we committed to buy, is a single family for rent company, some multifamily as well. We have a simple premise, which is in the United States today, we're building roughly the same number of homes as we did in 1960, when our population was basically half of what it is today. And we've been, unfortunately, underbuilding supply here going back to the financial crisis, so now for more than 15 years. And so that structural shortage provides support. And right now, obviously, the public markets are focused on this near-term deceleration, particularly in multifamily because of the new supply that's been built in some of the Sun Belt markets. And the stock market may take a little bit of a shorter-term view. And we look at that long-term structural shortage that's out there and say, if we can buy high-quality real estate in good markets at favorable prices, that makes sense for us to do. And that's what I mean by investing before the all-clear sign. And if you really step back, you think about it, you go back to 08, 09, you had a period of time where prices fell very sharply. Then you probably had another 3 years where we lived through a lot of bad headlines in real estate, because deals that were done prior to that crisis, the market was absorbing that. Those troubled deals were emerging, and there were a lot of negative headlines. People were patient. If you went back in time, you'd say, gosh, I wish starting in the summer of 09, when we started, fortunately, investing capital, I started putting out money because the prices had come down pretty significantly. Now, I'm not saying this is some sort of V-shaped recovery, because that's not how it works in a slow-moving asset class like that. But what's happened here is we've hit something, we've described it as bottoming. There's a lot of uncertainty today. And this is the kind of moment where you want to step in. And the positive signs on this, I'd say, are twofold. One, cost of capital has come down. Now, the 10-year's gone up here in the last few weeks, but it's still down relative to where it was in October. And most importantly for this industry, debt capital has become much more available. The CMBS market was up 5-fold in issuance in the first quarter. We saw spreads tighten 100 basis points. That's very helpful for this industry. And then back to that supply picture, over the intermediate, longer term, the fact that new supply of housing, hotels, warehouses down 50, 75%. That creates that sort of long-term runway. But it's very hard for all of us because we're like, well, what's going to happen next week? Is the Fed going to cut rates? What's going to happen to rents tomorrow? If you're thinking about investing capital, though, for 5, 7 longer periods of time, entering in points of high uncertainty and buying hard assets below replacement cost when capital availability is recovering but still more limited, that to me is the optimal way to do it. And so that's why you see us doing a number of fairly large things.
So housing is undervalued in the market compared to your assessment of it.
Our assessment, I think by definition, we paid very large premiums to buy both of these companies, and so the shareholders in these companies were rewarded handsomely. Yes, we have a differentiated view because we think, yes, there are challenges in the near term, but longer term, this is a strong sector because we haven't, as a country, built enough supply, and I think it's something politically we should try to find ways to do more of that, particularly in this city. But I think that's part of the opportunity. And if you think about identifying what we call good neighborhoods, we think rental housing is a good neighborhood, and as a result, we want to be a high conviction investor and lean into it.
Something maybe it's more out of favor than residential housing in the public equity markets is office. What's going on?
No. So look, the real estate industry's had a tough couple of years, right? Cost of capital went up a bunch, and in particular, the office sector has been badly hurt by one primary things, but I'd say some other factors. The primary hit was obviously remote work, which structurally reduced the demand for office space. Now, I'm in a place where we're believers in work from work. It's different than some companies. And every company has to choose their own path. For us to sort of build the culture and the team and to train the young people, we think it's really important to have them together as much as we can. But other companies have made different choices, and that might be the right choice for them. In addition to that, I think one of the reasons why office became very small in our portfolio, so if you went back thinking of Sam and Equity Office, after we closed that transaction, 62% of our portfolio in real estate was U.S. office buildings. Today, it's about 1%. And the biggest reason for that change, some of that's obviously happened post-COVID, but a lot of that happened because the CapEx was growing much faster than the rents, if you looked at it. Tenants were looking for newer, more modern buildings. What you'd have to spend as an owner was bigger. And landlords continued to look at NOI. They didn't look at cash flow after CapEx. And so I think right now investors are looking at office buildings through a different lens. Now, going back to the negative sentiment and everything, the decline in office building values has occurred. You see that when the buildings are put out for sale. Now, there may be buildings in an open-ended fund where the owner hasn't marked it down yet, or there may be loans on bank balance sheets. And one of the hard parts for people is to separate, well, this loan went bad, the tenant left, and it got into trouble. But that building's value has actually, it's declined already. So I think it is an interesting time to look at more modern buildings in office. I think older buildings, the CapEx needs are still substantial. And you're beginning to see in New York some of the buildings fill up, particularly the more modern buildings, better located buildings. So now the values are still down significantly, and they'll reflect much higher cap rates than the pre-COVID world, the pre-rate rise world. But if you said to me, I had an opportunity to buy a super high quality building in Manhattan at a price that's down significantly, yeah, I would do that. And we're looking in Europe as well. But it's pretty narrow in terms of the geographies and sort of the age of the building would be the focus. In Europe, there's a lot of concern about the green elements as well. So it's a sector that we'll look at, I would say, selectively.
What will happen to all the ones that are not worth looking at?
I think we're going to see, markets, one of the great things about capitalism is there's a healing mechanism to this, right? So we're not going to see a lot of new buildings built. We'll see a bunch of buildings torn down. We'll see in some places buildings converted, although I know there are a lot of developers in the room who can tell you how tough that is, how deep the floor plates are, getting the plumbing. It's a very expensive enterprise, and you have to buy the legacy office building inexpensively. At some point here, some of these markets will start to recover. Some of them will get, they may be foreclosed, but the rents, the new owners will rent them out at lower levels. It will take time. I think governments, those that are incentivizing rezoning, density bonuses, things to get different uses make sense. And this will find a sort of natural landing point. But it's going to take a while to heal, because when you have 25% vacancy of anything, that takes a long time. And by the way, some of the companies may pivot their policies back and say, hey, I need some more people in the office. And so I think there will be a correction, but it's a sector that's been re-rated. I think, not nearly as dramatically. We saw something somewhat similar in the mall business, right? I mean, the mall business until 10 or 15 years ago was the preeminent sector really from the end of World War II, let's say until 2014, 15, when people began to see the rise of e-commerce and what it meant in that space. And what we've seen in the mall business is a re-rating of values, higher cap rates. Now, of course, no one's building them, and some of the best malls are actually doing quite well. Some malls are, being demalled, torn down, and so forth. And so there's sort of a healing process that's gone on there. And I would think in the office business, something similar will happen over time. And there'll be some people who make a lot of money, either buying newer buildings at very low prices or older buildings and reconfiguring them. I have a lot of confidence in the people in this room that interesting things will come out of it.
Let's pivot for a sec, maybe talk about another sector that you've had more conviction on, which is data centers. Where are we in the world of data centers today?
So data centers are really the physical manifestation of AI and our lives online. If you went back in time from 2019 to 2023, we've seen an 11-fold increase in demand to lease data centers. Now, that is definitely the impact of AI. You see it in NVIDIA's share price, but that's another interesting, no pun intended, data point. And what's happening is to run these large language models, you need an enormous amount of compute power. You need to put these GPUs together. And by the way, there's a whole power consideration I could talk about as well. But there is obviously a lot of demand for this. And the tenants are the biggest companies in the world with the largest market caps and the best balance sheets. And they are obviously in a race to build data centers and to have more compute power than others. For us, 3 or so years ago, we didn't really have much in that space. We've now grown that. We privatized the company QTS, a REIT, which we thought was trading inexpensively and had a very entrepreneurial management team who wanted to grow. We privatized that for $10 billion. We've put an enormous amount of capital into this business. We've also done a joint venture with Digital Realty we announced at the end of last year. We've set up a bunch of other platforms in different spots around the world. I was in India a couple weeks ago. There we've got a platform going. In total today, we have $50 billion of data centers that are operating or under construction. And I'd say probably another $50 billion in various stages of development.
That's just the Blackstone, not the world.
That's just the Blackstone. It gives you the sense of the scale of the opportunity. Now, what all of you should be, I think, asking is, wow, is there a bubble aspect to this? And is there something that's been overdone? And I'd say the good news is there are a couple of limiting factors. One is, unlike much of what you do in real estate, we don't spec build these things, right? You're not going to go spend $2 billion and hope a tenant comes along. So particularly when you're doing mostly what we're doing is building for the hyperscalers, the biggest tech companies in the world, you're waiting to get pre-let. And you know your yield on cost, you need the capabilities to do it. The second thing is power is becoming a real shortage. And if you think about, the United States, if you use the mid-Atlantic of the US and you looked over basically the last decade until a year or two ago, basically power consumption in the mid-Atlantic of the US was flat. we obviously were getting more efficient, manufacturing was going away. Now we had some onshoring, some EVs, and particularly data centers, and the projections for the mid-Atlantic of the US is a 70% increase in power usage over the next decade. So getting power becomes the limiting factor for data centers. So you need very skilled teams. You need, obviously, to have relationships with utilities. We happen to, in our infrastructure business, have a very large green energy development business, which is we're also incorporating in this. But this is a huge opportunity. We're doing it in infrastructure. We're doing it in our non-traded REIT, BREIT, and in our institutional Core Plus business. And it's obviously very large, and it's the largest investment really theme at the firm today. And I think what's happening in AI is really, really powerful, but it is going to, the challenges around power are going to become more acute. You've seen in Ireland, where it's gone up to be a quarter of the grid, they've really limited now new data centers. And so there are going to be some interesting questions that get involved as we want to move forward on technology. We definitely are going to need to figure out how to have better transmission, how we can hit green targets, and also be technologically forward-leaning. So that's very complicated.
Quarter of the grid, is that like Ireland is a hub for data centers?
Ireland
for
is
the EU?
an absolute hub for data centers in the
Quarter of
EU.
the grid is unbelievable.
Unbelievable. And look, Northern Virginia today, there's a lot of pressure on the grid there. That was the US hub for data centers. Now you're seeing them being built in Indiana and Ohio and Oregon and all over the country, Arizona. So this is obviously an area where there's a huge need for capital. And when you think about investing through some of these megatrends, digital infrastructure would be a really big megatrend. The need for power, and as much of that power to be green as you can. It's got to be economic, obviously, done through a fiduciary lens. There are these big things, what's happening in life sciences. And as a firm, what we're trying to do is identify some of these good neighborhoods. So you believe in life sciences, so, okay, I want to own the buildings. I want to own companies who run trials. I want to invest in the phase 3 drugs themselves. Try to be thematic, lean into some of these great areas, and use the insights we have around the globe, and then express that in a bunch of different business units.
One of the things you touched on there is sort of the multiplicity of different kind of vehicles that Blackstone has today. I remember, 20 years ago you were here when we talked about buy it, fix it, sell it, and we were talking about limited life funds. Is any of that data center stuff in limited life funds? And tell us a little bit about all those different kind of vehicles that you have now.
The vast majority of the data centers are in longer lives, perpetual vehicles. Some are in some of the shorter buy it, fix it, sell it, opportunistic funds. The needs for capital are obviously great, so we're using a lot of different tools to address the opportunity set. What's interesting in real estate specifically is we have today 3 active funds, a $30 billion global fund, mostly US and Canada, and $10-ish billion European opportunistic, 8 or 9 billion in Asia. So almost 50 billion in the buy it, fix it, sell it world. And that's still, that's where we started our business. It's still a huge part of what we do. Those big deals you described, we're in those vehicles. But we also now have large perpetual vehicles. So a big individual investor business, BREIT, and then our BPP institutional Core Plus business. And we think they're all complementary. The way we think about it is, if investing is really about pattern recognition, connecting dots, if we have more dots than anybody else, we can see what's happening on the ground and connect those dots. And the fact we also have a very large real estate debt business. And we do everything for senior lending for our insurance clients. That's very tight investment grade spreads up to more opportunistic lending. We can meet with almost everybody in this room and say, hey, you want a minority equity partner? You've got an empty building that needs to get repositioned. You've got a stable asset. You want 50% leverage with 10-year fixed rate financing. Having all those tools is really helpful, and it's made our real estate business better. I don't run the real estate business anymore. I can try to take credit for it. But today, Kathleen McCarthy and Nadeem Medji have done a phenomenal job. Ken Kaplan, who was just promoted to be our co-CIO at the firm also, and the leadership of that team's done an amazing job. But the scale we find is a huge advantage.
In terms of the real estate business, where it is today and where the people who are running it under your encouragement.
Yes.
Where's it going to be in 10 years?
Well, I think it's interesting. We're obviously in a period now where real estate has fallen out of favor. And all of us who've been here and gone through this over time, it's a cyclical business. For the younger people, for the students, it's not always like this. I mean, today, you're going to read all these articles, real estate's horrible. You know, everyone's going to try to figure out that how do I avoid real estate, all this stuff. But as we've talked about here, at some point, cost of capital comes down. There's less new construction. People still live in buildings, travel to hotels, store their goods in e-commerce, which is obviously logistics has been the biggest area for us investing, and it'll come back in favor. And investors, of course, will come back at some point too. And in my mind, when you look at our business, it's pretty simple. It's a bit like a restaurant. At a restaurant, if you serve good food, the customer comes back, orders more, and tries different things on the menu. In our business, if we deliver good returns, the exact same thing happens. They re-up for that same fund, maybe they do it in more size, and then they try different things. And so if we can continue to deliver differentiated performance, I think our real estate business has an opportunity to scale pretty significantly, even from where it is today. And that's why we try so hard and focus so much on delivering the best product for the customer, because that's the ultimate determinant of our success.
Obviously, for those of us involved in the M&A business, when Blackstone privatizes a company for $10 billion or $40 billion, it's an opportunity. What do you think about the public REIT sector? I mean, we were talking this morning about, you know, the sector is up to 1.3 trillion, all this kind of stuff. Where do you think the public REIT sector will be in terms of portion of investment and size?
I think the public markets will continue to play a very big role in real estate. We've always been on both sides, right? We've sponsored REITs to go public. We've done plenty of privatizations. We've sold to REITs. I think it's a very efficient structure for individual investors. The tax structure encourages investment, which is helpful. But at times, of course, sometimes public REITs trade below value. And one of the good things is having a market where you can privatize, and that provides support to the remaining REITs. I think it grows a lot over time. I think the composition continues to change. I think some of these, you know, if you think about all this digital infrastructure, if we're just a fraction of what's happening, more of that's probably going to have to find its way into the public markets over time. Could be the towers, could be fiber, other things. I would say this will grow, not only in the US, but around the world. I mentioned India. We helped change the rules there. We've taken 3 of the 4 companies public. We're working on others. I think this is a sort of tried and true structure that works. And I think this is an industry that'll continue to grow. And it's an efficient way for real estate to be owned. But I think it coexists nicely with a robust private market, which is interesting. In real estate is much larger than the public market, which is different than the dynamic in corporate assets. And so it creates the opportunity when things trade at values where they can be privatized, they can come back and so forth. So I think it's a very healthy system. It's obviously been a tougher couple years, but at some point here, the sun's going to come back out and people are going to be very interested, and we'll see a whole series of REIT IPOs when the market gets really excited. Because the great thing about the public markets is they tend to move faster. So when the public markets get excited, they'll drive up the price of an asset class. They'll suck in lots of assets into the public markets. That'll happen. And right now, we're not at that moment, but at some point, it'll come again.
You touched on India, Europe. You mentioned Sam going down to Brazil and Mexico. Where else are you interested in the world these days?
Well, I would say there are a couple of things happening. There's obviously a big supply chain diversification phenomena. You know, people are looking for, there was a lot of concentration of manufacturing, and now people are saying, I want to have different locations, sort of China plus one and other strategies. And we're seeing Southeast Asia is benefiting from that in a big way, Vietnam, Indonesia. India certainly coming off a pretty low base. I mean, India is the same population as China, but 1/5 the GDP per capita. And they're going to benefit from more manufacturing there, but also their IT services and just a growing middle class. I think Mexico is interesting because of the same sort of diversification of construction, of manufacturing, and it's been beneficial there for the real estate business. And then I would say generally, wherever technology is housed and knowledge workers are, those tend to be good places to invest if you think about it from a real estate standpoint. So that's bullish, obviously, for places like Scandinavia. Israel, unfortunately, is in a very tough spot today, but long term, that tech strength is obviously helpful. A city like Toronto has really benefited because of their immigration policies. And in the US, we see people, it was all the West Coast. That's now spreading out in different places. But, if you sort of follow the talent in the tech, I think interesting London, which has really fallen out of favor post-Brexit, post the events the last 2 years ago, summer. I think London, because of its ability to attract knowledge workers, AI, life sciences, is a place that's going to come back and is probably undervalued.
Thank you. I want to keep you on schedule and keep our program on schedule, but we're here under the aegis of NYU. We have a ton of Schack students here. Other than, be brilliant and pick the right first job, what's your advice to people interested in the industry, whether fund management or real estate?
Well, I'd start with you have to love the business. So I was very fortunate. I started in M&A and private equity for a year, and the real estate business had collapsed. And John Schreiber, another Chicagoan, formed a joint venture with Steve Schwarzman and Pete Peterson, and that's where I got really lucky. And I fell in love with the business. I like the physical nature. I like the fact, even without a lot of domain expertise, you can land in a neighborhood and get a feel for how that is. And then I love the people element, right? I mean, I look around this room and I know a lot of people. You're in different cities, you talk to different people, and you learn a ton. And I love that travel element and what you learn seeing different places. And then the investing for me was the other thing. To me, it reminded me of sports, right? There's a scoreboard. You put $1 in, do you get back $0? You get back $1, you get back $3. You can track how good you're doing. And as an investor, for me, I would say you're trying to think about the future. I mean, in real estate, you're trying to figure out, okay, I see what happened in Brooklyn. Where's the next Brooklyn? And try to connect those dots. So I guess I'd start with, you've got to really love what you do. And then I would say the second thing is you really have to throw your full heart into something. And, when you see people who are exceptional, we were talking about Taylor Swift and her performances, or you see Steph Curry or Michael Jordan, these people are not only naturally gifted, but they care so much about their craft and they put so much time, effort, and energy. You have to be all in if you want to achieve, I think. And then the last thing I'd say is I think trying to be a little bit nicer to people. I think sometimes in the real estate business or in the financial world, there's this idea we need to be sharper elbowed. That's the nature of the business. But what I've found is if you're nicer to people, the lawyers, the investment bankers, the people who run companies are more inclined to do business with you. Plus, it's more fun because you want them to be nice to you. So, I just say find something you truly love, go all in, and do it in a way where you can find also a place where you like the people you work with, you have a shared sense of mission, and you get real rewards from it. And I just feel incredibly fortunate to have found a place like that.
John, thank you so much for having joined us today. Really appreciate it.
Thank you. Thank you. Thank you so much.